Hey, all of you, welcome back. Today we are going to talk about a long call and how do you model a long call. In order to understand this session, it's recommended that we have a basic understanding in terms of what is the intrinsic value of options. And in this case, intrinsic value of a call option. So let's first talk about what is intrinsic value of a call option. An intrinsic value of a call option is max of the spot price minus the strike price associated with the option, comma 0. And we are going to use this intrinsic value of call option to model a long call. Now, in order to model a long call, we first need certain basic assumptions. Assumption number one would be underlying. What is your call option based on? Let's assume this is based on the index Nifty 50. Second assumption, what is the strike price? I'm taking a strike price of 25,500. And then comes the premium. The premium that I'm going to pay because this is a long call, I'm expected to make a premium payment. So let's assume I'm going to make a premium payment of 130 rupees. Spot price as of today, the Nifty trades at 25,000 levels. So those are our basic assumptions. Now, when you have to model any option, we have to set up the entire mathematics related to that option. The first thing for an option model will be what is your spot price at expiry. Now, this is an assumption. This is something that you assume that the spot price at expiry would be, let's say, below 25,000, which is the spot price, or above 25,000, again, which is the spot price. So it's based on your directional expectations from the index. I'm going to model, let's say, the Nifty falls to 24,000 or let's say 24,500, and it may range anywhere between 24,500 to 26,100. So that is my expected range of Nifty. Now, based on these expected range of Nifty or spot prices, either one of them will be true, right? Not all of them will be true. At expiry, only one of the scenario would be correct. I'm going to calculate the intrinsic value of my call option, assuming Nifty expires on any of these levels. So as I said, it would be max of spot price. Now I'm assuming Nifty expires at 24,500 minus my strike price, comma 0. And we can drag the formula down. You will notice if the Nifty goes below my strike price, I don't make any intrinsic value. But as the Nifty crosses the strike, this is my strike. As the Nifty crosses the strike, I make a 100, 200, 300 rupees of profit. But in order to get this profit, I had to make a premium payment. So that is my next column. I have to pay a premium to play this game, and that premium is 130 rupees, which means my net payoff from a long call strategy is intrinsic value minus the premium paid. Initially, I'll make 130 rupees of losses. I'll gradually recover my loss as Nifty moves above my strike price, and then I will move it to a larger profit. How does this look on a graph? And this is, I think, what some of you would have seen as part of your textbooks. A graph for a long call would look something like this. This is the payoff. And if you observe the payoff, you continue to make a loss of 130 bucks. You gradually start recovering your losses as Nifty crosses your strike price and goes to make infinite profit for you on a long call. So modeling long calls is extremely easy. I think what you need to remember are four basic inputs that we have here: spot price at expiry, intrinsic value, premium paid, and a net payoff. Remember, Nifty is going to expire only at one of the levels. If Nifty expires at 24,700 at expiry, you're going to lose the premium paid. But if the Nifty goes to 25,700, you make a 70 rupee profit. And that is how you model a long call. I hope this was helpful.